Imagine a company so powerful, so admired, that was hailed as the future of American business. Its stock soared to over $90 a share, making employees and investors rich. Then almost overnight, it imploded. Not just a stumble, but a complete, catastrophic wipeout. Your retirement savings, your job, your entire future vanished, swallowed by a black hole of corporate deception. This is the story of Enron, a titan that, in late 2001, plunged from nearly $91 a share to less than $1, leaving a trail of human wreckage that still echoes today. How could a company so grand, so untouchable, simply vanish? In the late 1990s, Enron was a name synonymous with innovation. The seventh largest company in the United States, it projected an image of unstoppable success, a new breed of energy giant. Founded in 1985 by Kenneth Lay, who merged Houston Natural Gas and in turn North, Enron quickly positioned itself as a pioneer in energy trading. They weren't just moving gas, they were trading futures, bandwidth, weather, even the very idea of energy itself. It was a vision of boundless potential, attracting ambitious minds like Jeffrey Skilling, who joined in 1990, and Andrew Fastow, who would become Chief Financial Officer in 1998. Under Skilling's aggressive leadership, Enron's growth was nothing short of spectacular. From revenues of $13.3 billion in 1996, they rocketed to an astonishing $100.7 billion by 2000. This wasn't just growth, it was a revolution. Their online trading platform, Enron Online, launched in 1999, was touted as a game-changer, solidifying their reputation as market innovators. By mid-2000, Enron stock hit its all-time high of $90.75 per share. It seemed there was no limit to their ascent. Employees were encouraged to invest heavily in company stock, their 401k, as often nearly two-thirds filled with Enron shares. They were buying into the dream, a dream built on the promise of perpetual growth and a relentless pursuit of mark-to-market accounting. But beneath this dazzling facade, Enron was meticulously constructing a house of cards, built on two primary pillars of deception. The first was what they called mark-to-market accounting. Imagine you're a builder, and you sign a contract to build a skyscraper that will take 10 years to complete. Under traditional accounting, you'd only record profit as you complete stages of the building. But Enron's mark-to-market system, approved by the SEC in 1992, allowed them to book all the projected future earnings from that entire 10-year skyscraper contract immediately as current income. Even if the project hadn't broken ground, even if the deal was speculative or based on wildly optimistic assumptions, this created an instant, artificial surge in reported earnings, regardless of actual cash flow. Their claimed net income for 2000 was $979 million, but later restated to just $42 million. Their claimed cash flow, a positive $3 billion, was later revealed to be a negative $154 million. A massive gap between perception and reality. The second pillar was an elaborate network of special purpose entities, or SPEs. Think of these as secret compartments, shell companies with names like LGM1, LGM2, and Chuko. Led by CFO Andrew Fastow, Enron used these SPEs to hide massive debts and poorly performing assets off its main balance sheet. It was a magic trick. Hundreds of millions in liabilities vanished from public view, making Enron appear far healthier than it truly was. But these SPEs weren't truly independent. They were often funded by Enron's own stock or guaranteed by Enron itself. This meant the entire structure was precariously balanced. If Enron's stock price ever dropped, the SPEs would crumble and the hidden debts would come, crashing back onto Enron's books. It was a house of cards, just waiting for a gust of wind. For a long time, the illusion held, but cracks were beginning to show. In February 2001, Jeffrey Skilling took over as CEO, only to resign abruptly in August, citing personal reasons. This sudden departure sent ripples of unease through the company. Just days after Skilling's resignation, a brave vice president named Sharon Watkins sent an anonymous memo to Lay, warning of accounting irregularities. She described a dark cloud hanging over the company, predicting that Enron would implode in a wave of accounting scandals. Her words were prophetic but largely ignored. Meanwhile, Skilling himself had displayed an unnerving flippancy, famously joking about the California energy crisis. What is the difference between California and the Titanic? This kind of arrogance, coupled with a fiercely aggressive culture, masked the rot within. The facade couldn't hold forever. On October 16, 2001, the first public tremors hit. Enron announced a staggering $618 million loss and a $1.2 billion reduction in shareholder equity. They admitted they would need to restate their financials from 1997 to 2000, revealing a colossal $613 million reduction in reported earnings and a $628 million increase in liabilities. The SEC immediately launched an investigation. Just 8 days later, CFO Andrew Fastow, the architect of the SPEs, was fired. The dominoes began to fall. The company's stock, which had once reached over $90, was now plummeting. By late November 2001, it was trading at less than $1 per share. On November 28th, a last-ditch $9 billion buyout offer from Dynegy was withdrawn. There was no escape. On December 2nd, 2001, Enron, with $63.4 billion in assets, filed for Chapter 11 bankruptcy. It was the largest corporate bankruptcy in U.S. history at the time, beginning a chilling legal saga. The Justice Department launched a criminal investigation in January 2002, and Enron's auditor, Arthur Andersen, was caught destroying documents, leading to its conviction for obstruction of justice and ultimate dissolution. The human cost of Enron's collapse was devastating. Thousands of loyal Enron employees saw their jobs vanish overnight. Even worse, their retirement savings, heavily invested in company stock, were completely wiped out. Sarah Jones, a mid-level manager who joined Enron in 1985, had invested 80% of her 401k in Enron stock. Valued at nearly $600,000 in early 2001, it was almost entirely lost within weeks. Imagine decades of hard work gone. Tyrone Willingham, an employee in the accounting department, not only lost his job, but also his savings, eventually turning to teaching high school math to rebuild his life. These weren't just numbers. These were real people, real families whose trust was shattered, futures destroyed. Shareholders, including mutual funds and individual investors, suffered billions in losses. A class action lawsuit sought $40 billion, with victims eventually receiving $7.2 billion, a fraction of what was lost. The ripple effect was enormous. 85,000 employees at Arthur Andersen also lost their jobs when the firm, once one of the Big Five accounting giants, dissolved. The local economy of Houston, a major employer, felt the significant impact of job losses and reduced purchasing power. In the aftermath, the legal system pursued justice. In January 2004, Andrew Fastow pleaded guilty to securities and wire fraud. In May 2006, Kenneth Lay and Jeffrey Skilling were convicted on multiple counts of conspiracy and fraud. Fastow was sentenced to 6 years, Skilling to 24 years, later reduced to 12. The scandal led directly to the passage of the Sarbanes-Oxley Act in 2002, a landmark piece of legislation aimed at improving corporate governance and accountability, ensuring that such a grand deception could never happen again, or so we hoped. The collapse of Enron remains a cautionary tale of unchecked ambition, corporate greed, and the fragility of trust. It exposed a culture where profits were prioritized over ethics, where the line between innovation and fraud was not just blurred, but erased entirely. The irony is stark. Andrew Fastow, the architect of the SPEs, after serving his prison sentence, now consults with boards of directors on identifying and managing gray zone risks, the very ethical dilemmas he once exploited. Enron promised to revolutionize energy, but instead, it revolutionized corporate fraud. Its legacy is a stark reminder that beneath the gleaming towers of success, a meticulously constructed illusion can hide immense darkness. And the human cost, the shattered lives and lost futures, is a price too high to pay. What other illusions, what other gray zones, might be lurking in the shadows of today's markets, waiting for their own inevitable collapse? The story of Enron serves as a chilling echo urging us to look closer, to question harder, and to never mistake perceived success for genuine integrity.